Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. So the stock market today surprisingly closed slightly up on the S&P 0.3%, slightly down on the NASDAQ 0.25%, and slightly up on the Dow, nearly half a percentage point up. Taking a look at the different sectors leading the day were healthcare, utilities, communication services, and consumer defensive. So a lot of defensive posturing today, except for communication services, which is typically a risk-on sector. Cyclicals, real estate, and financials are flat. The laggards of the day were basic materials and energy. So both inflationary sectors are now deep in the red. Taking a look at the stock market map, we can clearly see concentrations of selling in energy, basic materials, as well as semiconductors, and software application companies. Now, both energy and basic materials are selling off for a multitude of reasons. Number one, it appears that inflation in Germany and Europe in general may have started to top. We're seeing a double top in German inflation. And we're also seeing the ECB preparing a jumbo-sized rate hike. Goldman Sachs and JP Morgan both are now expecting the ECB, the European Central Bank, to raise rates by 75 basis points. This would be a historic rate hike by the ECB, and we're seeing the direct effect of that on the energy markets today. Semiconductors, on the other hand, guys, are down because the US has informed NVIDIA and AMD in a letter, I believe, yesterday, that they will be completely blocked from exporting their fastest and most advanced chips to China. This is estimated to impact NVIDIA's revenue by $400 million. And is expected to impact AMD's revenue by about 5%. And as this Cold War between the US and China continues to heat up, we'll see a lot of things like this happen, a lot of unexpected volatility pour into the market as regulators in both countries take jabs at each other, and that has taken down the entire semiconductors sector. Now, software applications are down for a completely different reason, and it's this, guys. It's the 10-year yield. Now, as you all know, guys, and as I've explained many times in my previous videos, as the yields rise on the treasuries, this leads to significant compression in company valuations, and the companies with the highest valuations in all of the stock market happen to be software companies, and that's because they are very high margin businesses, and they grow at a very fast rate. But they're also trading at insane multiples. I've seen companies trading at 400 forward earnings, which is absolute insanity. So I expect valuation compression to continue in this space. Now let's take a look at the daily chart of the S&P 500, and just like clockwork, as soon as we hit that $390 level that I've been talking about for weeks and weeks now, we've seen buyers step back into the market and push the price back towards the lower edge of the weekly expected move. And so, guys, it's reasonable to expect a small bounce to come in the short term. On the daily chart, we've been selling off very aggressively. In fact, we haven't seen a touch of the 9-day EMA really since we got that rejection on the 26th last Friday. In previous sell-offs, guys, it is actually fairly common to see a retest of the 9-day EMA, right? We had one retest here, and we had another one right here. In this sell-off here, guys, we had a retest right here, and another retest, and one more retest here. So it's common to see a retest of the 9-day EMA. In some sell-offs, we do not see any retests of the 9-day EMA, but we do tend to see a retest of the 9-period EMA on the 2-hour chart. That is common, even in aggressive sell-offs. And in this most recent sell-off, we've had that a couple of times now on the 31st of August and again today. And today, in fact, we closed above the 9-period EMA on the 2-hour chart. And on the 1-hour chart, guys, we do have a tiny double bottom formation right over here. You can spot it, right? We had two bottoms right here with a very slight divergence on the PPO, right? We made a slightly higher low right here. I do need to caution, guys, that bullish signals in the 1-hour chart tend to play out in a matter of 2 to 3 days maximum. So if you are playing this bounce, guys, just make sure to manage risk and take profits, please. Don't let a winning trade turn into a losing trade. Taking a look at the medium and longer term, we're still squarely in a downtrend, right? PPO are still pointing down. we're still seeing lower lows and lower highs, but we could still see a slight bounce back to the upside. I also want to mention, guys, that shortened trading weeks like next week, thanks to Labor Day, we'll only have 4 trading days next week. These weeks tend to be more bullish than the average week. In terms of seasonality as well, guys, we do tend to see some buying right after the beginning of September, right? Really, in every midterm year, we saw small bounces right as September began, and then we saw a continuation of the selling after around mid-September. So we do have some bullish developments in these smaller time frames like the 1-hour chart, and we do have seasonality on our side. To the long side, we've also already tagged our price target at 390 and the lower expected move for the weekly chart. And so again, it is reasonable to expect a small bounce to come. I did look at our trusty HYG chart, the high yield bond chart, which has served as an amazing tool to spot changes in trend. Significant changes in trend is spotted every single top in the stock market and predicted every sell-off this year, every major sell-off. And then I did talk a lot about these divergences, guys, in the previous videos. If you want to know more about them, please check out my last video. These divergences, guys, also work to spot bottoms, but I've yet to see a divergence between the HYG and the S&P as of now. However, that does not mean that we could not see a bounce to the upside. For example, right here on May the 2nd, we had a small bounce to the upside on the HYG as well as the S&P right here, without seeing any divergence between the two. However, guys, that bounce ended up resolving to the downside eventually. And so without a significant divergence between the HYG and the S&P, and without the larger time frames on the daily chart and the 2-hour chart showing us some divergences, some double bottoms, etc., some bullish structure, we have to be really cautious around any bounce that comes, because we haven't seen really any major bullish structure so far. So just play these very short-term bounces to the upside. That's what we plan to do. In our trading community, I did take profits on all of my short positions on the S&P. I had 2 put positions that I opened. One I opened right at the top. The second I opened after this breakdown. The first put position netted a 200% profit. It turned a $5,000 initial capital into $15,000 and netted us $11,000 in profits. The second put position was a put spread, again, that I opened right here. And I also took profits on that, and that netted a 150% in profits, a 2.5x trade. So today's been really good for us in the trading community. By the way, guys, I do post every single trade and investment that I make in real time. And I recently started significantly ramping up my portfolio buildup because I've been sitting on 80% cash in my investment account. And I've been waiting patiently for this sell-off in September and in October to build out my long-term portfolio. So if you're interested in that, guys, if you're interested in trade ideas, strategies, chart analysis, really lively and productive discussion, we would love to have you in the trading community. It's $20 a month. If you want to support me, that's the best way you can do it. Now let's take a look at the daily chart for the triple Qs. Again, guys, we're seeing a significant breakdown of the triple Qs right here. We had this support line that broke just a couple of days ago. And so, guys, it is reasonable to expect the triple Qs to attempt a bounce back up and likely get rejected right off this previously a support line, now turned into resistance. So right around 307, I'll be looking for a rejection right at that level. This also happens to be near the top of this cluster of daily candles, so it also makes sense from a candlestick pattern for this bounce back up, possibly forming a bear flag that eventually takes the triple Qs down further. And let me bust out this chart. This is the triple Qs divided by the SPY. This is a ratio chart, and again, this chart is a really nice barometer for risk on and growth over value. And when we see a growth start to underperform value, that's when we tend to see significant selling in both the S&P and the triple Qs. So when this ratio is moving down, it indicates major weakness in the market, and we did end up breaking this previous support line. And in fact, now I expect a ratio chart between the triple Qs and the S&P to retest the May lows. Now let's take a look at the SPY divided by HYG. This is the S&P divided by the junk bonds. And again, this is a very useful chart to track short-term trend changes and bounces as well as sell-offs, right? The HYG divergences are amazing in tracking significant trend changes, and the ratio chart between the S&P and the HYG is useful in tracking very minute small bounces in the stock market. When you start to see the S&P beginning to outperform the HYG, that indicates a higher risk appetite, and that indicates a small bounce is coming in the S&P 500 and the stock market generally. And so we're beginning to see more risk taking and a cluster right here. We had one red candle right here, another red candle, and one green candle, right? So we had selling, and buying eventually at the same level. And broadly speaking, generally speaking, this candlestick pattern is usually bullish, at least in the very short term. Again, getting back to the 10-year yield, we had this bull flag forming for a while, and eventually we saw that breakout yesterday, and again today a continuation of the move to the upside by the 10-year yield. Unfortunately, we were sitting at a very critical level at which we could have actually seen a head and shoulders top, right? After 3 major indecision candles, the market ended up making a decision to the upside, and we had significant expansion in the momentum to the upside. This is unfortunately very bearish for the stock market. So again, please treat any bounces to the upside as very short-term opportunities. It'll be very interesting to see where the 10-year yield tops out. We might see a double top, or we might see a new high with the 10-year yield going all the way up to 4%. That is still possible. Because in fact, Loretta Mester, one of the most hawkish FOMC members, did say that she supports a 4% handle on the federal funds rate by the beginning of next year. And so that's significantly above the 3.5 to 3.8 handle that the market was expecting. We're seeing the same thing on the 2-year yields here, guys. We're seeing the same thing. We're seeing a continuation to the upside after we had this really sizable bull flag. The likelihood of the 2-year yield hitting 4% is significantly higher than the 10-year yield. However, the longer the Fed keeps interest rates high, the more time it gives the 10-year yield to move up significantly higher, putting even more pressure on the stock market. Today we had a breakout of this bull flag on the dollar index. So again, expect volatility and more selling to come. And even if we see a bounce up in the S&P 500 tomorrow, just be wary, guys, that big money is flowing out of the stock market and into cash. And so any small bounces that may come, just treat those as normal price variations within a very volatile market, not necessarily to be interpreted as a new uptrend. Taking a look at gold, gold just took out the previous lows that we've seen in July. We are very, very close to my target of $157 on the GLD. We need to see the dollar cool down. As soon as the dollar cools down, all of the money that's been flowing into the dollar will flow out of the dollar and into gold. And as long as the dollar keeps pushing to the upside, it will put a lot of pressure on all commodities, including gold. But I do like this level right here. I just simply need to see some structure starting to form on gold. If we see a few more trading days that hold this level right here, and then I start to see the PPO starting to curl back over, that would confirm a double bottom formation with a divergence on the PPO, and that would be bullish for gold. Let's take a look at oil. Oil took a major dump on everybody after taking out the 50-period daily moving average right here. On Monday, it ended up completely reversing Tuesday and continuing to sell off. Unfortunately, on the weekly chart, guys, this looks like one very ugly bear flag. In fact, this looks almost exactly like the structure that we had back over here. The major difference though, guys, is that this bear flag ended up resolving to the upside, while this bear flag appears to be trying to resolve to the downside. In fact, we have already taken out the weekly lows of last week at $96, and I did say if oil takes out $96, be very careful. In fact, I did exit all of my energy trades And I am now simply waiting and watching. And next week, if we see a new low that takes out this week's low on crude Brent, that will mean a continuation of the downtrend in oil. Now let's take a look at Exxon Mobil, the Apple of energy. Exxon is still holding on, right? We haven't taken out this previous resistance line, now turned support. We're still hanging around the 20 daily moving average. Now, on any given day, I would say that this is very bullish, right? Because we had a breakout and a retest. Unfortunately, as long as oil prices continue to move down, I simply cannot say for sure that this uptrend will continue. I will have to see what oil does. And if oil continues to move to the downside, this could very well end up being a false break top, and we see significant selling come right after that. So the next few trading sessions will be very critical, and next week is going to really determine the fate of the energy sector. Let's take a look at the VIX. The VIX has now formed a bull flag right over here. Very surprisingly, guys, the VIX has stayed very tame despite the massive selling that we've seen. We still have ways to go before hitting this resistance line right around 31 on the VIX. And so again, as long as we continue to hold these high levels and as long as the VIX continues to put in higher lows and higher highs, expect more selling to come in the market. Tomorrow, if we see a bounce up in the S&P 500, we could see the VIX pull back down to test the 9-day EMA right around the 24.5 level. But overall, volatility is still trending up. And in the medium term, I think the stock market is still very vulnerable. Let's take a look at Apple. Apple is finding support right around the 50-day moving average, right? We're very close to my target of $150, which is a major pivot zone because it acted as support. Once we broke through it, it acted as significant resistance. And again, once we broke through it, we had a retest and a nice rally after that. So we could see a small bounce up in Apple in the very short term. And after that, we could see the selling continue. Let's say not next week, the week afterwards. Same thing here, guys, with Tesla. We're seeing the 50-period daily moving average hold. We are now below our previous pivot zone. My target remains at $250. Right around here where we saw significant selling in the past. This level will now act as a magnet and a level of demand. But again, guys, we could still see some small bounces to the upside in the very short term, touching the 9-period daily moving average. I do want to pull out AMD and NVIDIA. AMD came very close today to touching the lower edge of this ascending channel. This channel goes back 6 years. We've been trading perfectly with this within this channel. I did start to accumulate AMD shares right here. I bought my first batch of AMD shares at $77. I bought around $80,000 worth of AMD shares, I believe. And I'll be looking to accumulate more AMD shares this month and next month. This is a nice morning star candle, right? Where we push to the downside and completely reverse to the upside. So tomorrow we could see a gap up and a run, okay? Usually, guys, after these kinds of candles, especially towards the bottom of a trend, we see a gap up and a run, just like what we had right here. And again, right here, a gap up and a run. So I think tomorrow we could see a gap up and a run to the upside, especially if some news comes out that the US government and China have come to some agreement about the AMD and NVIDIA chips being sold over there. And it's the same story here, guys, with NVIDIA. We are now approaching that lower edge of this ascending channel. We do have this morning star candle. And again, this candle, guys, tends to resolve to the upside with a gap up and a run. That's not always the case, guys, but more often than not, that's what happens. And I did, in fact, today, guys, open a very tiny position on NVIDIA for a trade to the upside. And I'm hoping to make anywhere between 1,000 and 1,500% out of this trade. It's a very, very tiny trade that could either go to 0 or 1,000%. And again, guys, if you want to follow my trades, do check out the link in the description below. Now, let's take a look at this beautiful chart. I've been waiting for years for this moment, guys. Waiting years and years for this moment. This is the AMD divided by NVIDIA chart. This is a ratio chart. And as you will immediately notice, there's this resistance line, right? We had a rejection right here, rejection, 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 and finally we broke through. Let me show you why I've been waiting years and years for this development. Because guys, the last time this had happened, right over here, where we had a rejection, 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 another rejection, and a final breakthrough, AMD ended up outperforming NVIDIA by 100%. AMD ended up outperforming NVIDIA by 100%. And if you guys have been following me for long enough, you will know that AMD is my favorite investment of all time. This is my highest conviction investment of all time. In fact, this is how I turned a very small investment in AMD into my first $1 million. I took AMD from $1.8. I rode it all the way to $150. In fact, let me show you on the charts. This is the monthly AMD chart. I got into AMD right around these levels, right around this retest at about $1.8. And I rode this for years and years and years. I held this stock and I got out right here at $150. So when it comes to timing the market, I don't think anybody was as lucky as I was. I got in at the bottom right before the breakout and I got at the top. Some luck was involved, but also some planning was involved as well. I worked for over 5 years in the semiconductor industry, specifically the PC hardware industry, and I knew for a fact that AMD was coming up with a groundbreaking product called Zen, the Zen Core. I think many of you, especially if you build your own PCs, will know what I'm talking about, the Zen Core. In fact, one of my first ever videos on this channel is by Jim Keller, the legendary AMD architect that led the development of Zen. And in fact, that's how I got into investing. AMD was how I got into investing, how I got interested in this line of work. And really the rest is history. So long term, guys, I intend to hold this investment, this AMD investment, really at least into late next year. I am anticipating a massive recession to come, probably by the end of next year. The inverted yield curve is predicting a massive recession is coming. And again, I talked a lot about the inversion of the yield curve, but it has a 6 to 18 month lead time. And about 3 months have passed since the initial inversion. And just about 1 month has passed since this deep inversion that we've seen in the yield curve. In fact, guys, let me pull up this chart so I can show you what I'm talking about. We had an initial inversion right here at the end of March, beginning of April. And then we had this deep inversion beginning in July. And if we go back, guys, if we take a look at the weekly chart, every single time we had an inversion right here back in the middle of 2019, we had the 2020 crash about 9 months later. And right over here, guys, in early 2007, we had the stock market crash beginning in early 2008 and really reaching its peak right around fall of 2008. Again, here, guys, we had this deep inversion in the early 2000s, just before that massive internet bubble burst, and we had that massive and very long bear market. And this trend, guys, goes back 120 years, back to the 19th century. Every single time the yield curve inverted, 100% of the time we had a massive recession follow and a crash in the stock market. So far, and going on 120 years, this indicator has had a 100% track record. Going back to our AMD chart, and so that's why I expect that within about the next 12 months to start seeing a massive sell-off in the market. But before then, guys, I expect the stock market to actually reach new all-time highs, and I expect AMD to do the same. In fact, I think AMD could easily retrace all the way back to the middle of the channel by fall of next year. So well above $200 by late next year. And I intend to hold AMD throughout next year, really for as long as I can before that recession hits. Now on NVIDIA, guys, I did start to accumulate shares. Here I did buy, I think about $25,000 worth of NVIDIA shares, right around $138.50. I intend to accumulate more NVIDIA shares throughout this month and next month. and add to AMD as well. I'm planning to build a core position around AMD, and I'm planning to add NVIDIA as well. Again, guys, if you're interested in following my investments as I build my portfolio, please check out the link in the description to join our trading community. Now let's move on to fear and greed. I want to show you a couple of things here, guys. We have the put to call ratio. It is shooting up today. We had a new high today in the put to call ratio, even though we're starting to see some bottoming in the S&P, right? Market volatility is cooling down, and we're seeing this very slight uptick in risk taking, and we're also seeing this very slight nudge to the downside in terms of the yield spreads between the high yield bonds and investment grade. And so we're seeing some more risk taking at these levels, and that makes sense. This is a key level, and I did expect a bounce off this level. I'm just cautioning not to trust these bounces to the upside as the beginning of a new uptrend. We don't know that yet. We have to see more structure. I have to see more technicals before I make that judgment. And so before that happens, and it could happen, guys, we might be bottoming right around here. Nobody knows. We could go even lower. We could fill this gap. We could go down to 366. We could even see new lows on both the S&P and the NASDAQ. Nobody can know. We simply have to trade the charts one day at a time. And the charts today are presenting us with a very, very tiny bounce to the upside, a possibility of a very tiny bounce to the upside coming in tomorrow and possibly next week as well. Now let's take a look at what we have coming up tomorrow, guys. Tomorrow we'll have the non-farm payrolls as well as the unemployment rate. This is going to be a critical number to take a look at, guys. The Fed is targeting unemployment to hit 5%. The Fed wants you to lose your job. The Fed wants you to spend less because the Fed wants to crush inflation. And the Fed believes that we're responsible for inflation, okay? The Fed thinks that people with jobs spending money, that we are responsible for that inflation. Not the fact that the Fed has printed trillions and trillions of dollars. No, it's your fault. It's the mom and pop's fault. It's the hard-working person's fault. It's our fault for buying groceries. Go figure. And so the Fed wants to see employment hit at least 5%. And so they're going to continue to put pressure on the economy to see more people lose their jobs. Unfortunately, that's the reality. And today, guys, we had very strong job numbers. The jobless claims came below expectations. Productivity came down slightly less than expected, and so that is also bullish for the economy. Unit labor costs came below expectations. Again, that is bullish. So the jobs market is strong and strengthening, and unit labor costs are coming in below expectations. So both of these things are actually good because unit labor costs are what the Fed believes is driving inflation, right? When you get a 10% raise in your paycheck, you end up spending that money on groceries, on gas, on whatever, on rent, because everything is getting more expensive. And so the Fed believes as people start to see smaller and smaller raises, as more people lose their jobs, spending pressure comes down, taking down inflation. And so overall, today's numbers, guys, were very bullish. And I did say that in the trading group. I, in fact, covered this live. I did cover this as soon as it came out. And I posted my interpretation in the trading community. Again, guys, link in the description below. And so tomorrow, I'll be watching the unemployment rate and the non-farm payrolls. I expect the non-farm payrolls to come in higher than expected because we know a lot of industries have been hiring in June, July, and August. For that resurgence in travel demand. I think we'll see some cooling of the jobs market starting next month as we see the report for September and October come out. But before then, I think the jobs market will continue to be red hot. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.